Straight into the big story tonight. Our focus is on the value of the rupee against the US dollar. Amidst this, the kind of pressures we are seeing, geopolitically speaking, and the somewhat bleak global economic situation, the forecast for rupee's value seems pretty dark. Analysts are saying that the worst may be yet to come when it comes to the value of the Indian rupee against the US dollar. Reports that we are poring over from UBS AG, from Nomura, also Bloomberg Economics, all of these reports are suggesting that the Indian rupee will go down to anywhere between 79 and 81 to the US dollar, and this could happen over the next few months. In fact, Nomura has seen the currency at 97 to the US dollar, and this could happen by the end of this month. Now, ahead of RBI's monetary policy meeting outcome, which of course takes place later this week on Wednesday, all eyes are going to be on how the central bank moves in, how it controls interest rates, how it controls inflation, how it stems the slide of the Indian currency against the US dollar. The RBI has, foreign exchange reserves, and those reserves run to nearly 600 billion US dollars. It's been using these reserves, this entire pile, to smooth out any kind of volatility in the Indian currency. But despite that, the rupee has slid. It's depreciated around 1.6%. This only in the month of May. It's the worst performing amongst Asian currencies. But amidst the kind of bleak forecast that we are getting, we are also hearing from other experts, and they are trying to help us understand how the depreciation of the Indian rupee is going to impact various sectors, all the sectors from crude to education. Let's connect with Dhiraj Nayyar, the Chief Economist at Vedanta. He's joining us, along with Jamal Mecklai, the CEO of Mecklai Financial Services. First to you, Jamal. Thanks for making the time for joining us on India Tonight here on ET Now. Jamal, how much further do you see the rupee slide against the US dollar? And what are the factors that you think will determine that slide going ahead from here?
See, first off, nobody can forecast anything, right? I've said that 1,000 times. But what I feel the real driver of rupee weakness has not been our weak and weakening current account deficit. All the reports you talked about were in response to, our current account deficit is very bad, oil is $120, etc. While all of those have an impact, the real force is the risk of mood globally, which means it really depends on if and when global equity markets stabilize. I was actually, just earlier today, I was of the view that global markets are going to really tank. I was of the view that global markets were going to recover because JP Morgan, Morgan Stanley, all these smart guys were saying the markets were going to collapse. Now, we all know markets' job is to make the smart guys look like fools. But then I'm saying, there's a lot of uncertainties. There's going to be a lot of volatility. I don't see the rupee collapsing immediately because RBI has got plenty of reserves. The reserves have gone up in the last 2 weeks, probably as a result of forward purchases being, not being rolled over or sold. So I think we're going to see volatility, but I don't think we're going to see, 80 on Wednesday.
Not an immediate fall, but do the fundamentals seem weak? Dhiraj, a lot of economists that we are hearing from, they are saying that the fundamentals are weak, and which is making the rupee deteriorate. Are you one of them?
No, the only fundamental, there are two fundamentals which might matter. One is inflation and one is the current account deficit. The inflation obviously is high, but in the current scenario, it's pretty high in the US and other countries also. So that inflation differential, which otherwise could explain, or explain a sharp decline in the rupee, is not really there. And current account also at the moment, obviously oil prices put a pressure, but I don't see fundamentals being, out of place. What I do see, ultimately, what is the exchange rate? It's about demand and supply again. Demand and supply for the dollar vis-a-vis demand for the rupee. And at this point, there is uncertainty, as Jamal Mecklai said. With uncertainty, there's always some flight to safety. The dollar is gaining in strength vis-a-vis most currencies. So part of, the decline is explained by the strength of the dollar. The equity markets, we know there's a lot of selling by FIIs and again, a beautiful flight to safety. So obviously, there is a demand for dollars, and RBI can defend it by doing the opposite. But beyond the point, I think RBI's job is not to manage the exchange rate. Quite clearly, their job is to manage inflation. But obviously, if it's excessively volatile, RBI needs to step in to prevent volatility. That said, I don't see that much reason to panic. Rupee is already at about 77. If it goes to 78, 79, I don't see it as any kind of crisis, really. And in fact, one thing which is driving the economy right now, economic growth right now, is exports. And at the margin, a slight decline in the rupee will help exports. Of course, with elevated oil prices, we don't want the imported inflation. But I think, I don't see a serious slide to 85 or below. I mean, if it's 79, 80, up and down a little, I see it'll only help growth and be marginal on the side of inflation. So I think I wouldn't be too concerned with what is going on around, be in panic mode. But obviously it remains to be seen what kind of interest rate hikes are carried out by the US in the months to come, what kind of hikes are carried out by the RBI, because a lot of the movement of finance will depend on that, and that I think is right now determining exchange rate much more than anything else, more than say the current account deficit at this point. But at some point, yes, the current account, but exports are strong, FDI is strong. So I don't see, fundamentally there being a problem.
So both of you are saying that at this point in time, you don't need to hit the panic button when it comes to the slide in the Indian rupee. But look at it slightly long term, because right now we're talking about recessionary pressures, not just building in the US, also in China, the two largest economies, and of course, greatest trade partners of India. Are you really saying that with the elevated levels of oil prices at the level that they are currently at, this widening current account deficit is not really a problem? Because as a percentage of the GDP, and Jamal, Mecklai, I'm coming to you with this, as a percentage of the GDP, the current account deficit for India has been a more sustainable 2%. Now it seems to be pushing 3%. Though you've said that foreign reserves are looking good at $600 billion, it isn't looking bad. But is it sufficient to take this pain going ahead from the immediate here and now?
See, there's no question, as we've both been saying, right, that the current account deficit is an issue. But the point is it a driver that's going to act tomorrow, right? I mean, things like the current account deficit over time, basically what happens, you can run a high current account deficit if the rest of the mood is good. But if the mood really suddenly turns dramatic, then they say, oh God, look at that, and it can collapse, right? So which is why I keep coming back to the point that I believe the real driver is going to be whether the Fed is able to control inflation or not. Right now, markets are thinking, maybe they've got it down. I'm not sure. So conceivably, we could see a quote, major collapse, even 6 months from now. But I think we have to watch the US equity markets. And if they really tank, right, people will say all bets are off. Now let's look at, who's swimming with our nichadis. And that's when the current account deficit will come into play. Of course, it's high, right? But I agree with Dhiraj that, I really don't see a major cause for panic right now. And I mean, markets are volatile. They don't know what they will do. Nobody knows what they will do. In fact, what we might see a period of stability.
Yes.
Followed by a collapse. I mean, that can happen.
So it might be further down the road. For the moment, Dhiraj, if I may ask you, because we live in inflationary times and that is not likely to change anytime soon. We are just about coming out of the impact of the pandemic. And at this point in time, when people are going out, they're vacationing, they're buying their newer phones, there is a lot of pent-up demand for many of these consumer goods out there. I'm talking about holiday travel. I'm talking about students going out for education outside the country. All of that is likely to get more expensive with the rupee slide. How do you think? Which are the sectors, which are the areas that you think will get affected most at the consumer level?
I mean, again, it depends on the slide. I don't see a slide from 77 to 79 or 80, which we're talking about at the moment, changing any of that dramatically. I mean, at the margins, it may makes things slightly more expensive. But yeah, I mean, if you then talk about a fall towards 85, 90, a very sharp fall, then things start making a difference. But I just want to say also that last time we're looking at a scenario like this, back in the taper tantrum 2012, 13, our foreign exchange reserves were, I think, less than half of what we have now. I think about 250 billion or so. Now we are at 600 billion, and they are not only, based on the speculative FII flows. A lot of it is coming from exports, which are, at an all-time high. A lot of it is coming from FDI, which is at an all-time high. So I think we fundamentally, I think we are in a much better position than we were, during the last episode that we had in 2003, the last scenario we were looking at of this kind. But that said, we don't know where this Russia-Ukraine war is going to go and when it might end or not end. As Mr. Mecklai said, we don't know how US equity, but there are a lot of unknowns. So obviously, it's better to be cautious. But at this point, I mean, I'm not an astrologer, so I can't tell you for sure, what's going to happen. But I think at this point, what is being predicted or what is expected, I don't think there's any need to panic. If at all, it may, in my view, the rupee has been overvalued for a long time as well. So it may actually help the competitiveness of the economy. And so I don't at all see any reason to panic now. 6 months down the line, who knows? But I still think what you asked at the start, I think the fundamentals now are probably stronger to face any such global event that Jamal Mecklai was talking about than it would have been, say, 5 or 10 years ago.
Jamal Mecklai, before I let both of you go, I want the final word from you. How effective a role do you think the RBI is going to play in controlling the slide as it happens? These rising prices are a cause of worry. That's established. Where do you think the RBI's comfort level is going to be with the rupee at this stage when they're firefighting inflation?
Well, I think, in fact, that was one of the points I wanted to make is there's one more weapon. If you remember last time, RBI raised rates out of turn, and they did it on the day the Fed was expected to raise rates, right? So, I mean, if things get crazy, they could raise it by the rates by 75 basis points. See, the Fed's rate hikes are all built into the market, right? Indian rate hikes have a more, shall we say, they have a more significant impact than the Fed's rate hikes. So if RBI feels things are getting crazy, on Wednesday, they could raise it by 65 basis points. That would cool things down completely on the rupee. So they've got this weapon, As Dhiraj is saying, we're not in that bad shape. So I don't even see it going to 89. I think it's just going to jockey around. It'll be volatile, but hey, that's what markets are.
Dhiraj Nayyar, thank you so much for joining us with your perspective on the slide in the Indian currency. Both of you seem pretty unperturbed right now with the kind of slide that we've seen. And for the moment, perhaps we don't need to hit the panic button. That's what both these gentlemen maintain. Meanwhile, let's